Hello everyone, welcome to our Chapter 5 slide voiceover. In today's walkthrough, we're going to look at spontaneous financing and bank operating loans. All of these topics are of interest to you both for the course and for the future because they're the tactical. You guys actually asked a question last night about tactical decisions in financing. Working capital decisions are pretty tactical. So here's some of the tactical opportunities that you have as an organization. So accounts payable and accruals is an opportunity for financing. We talked about that a bit last night, and I'll review that as well. Using a line of credit is another way of achieving some short-term financing. You can secure loans for accounts receivable and inventory, and then there are short-term financing opportunities that we'll go through. Now, spontaneous financing is all about accounts payable and the ability to leverage your suppliers really and have them finance your venture by pushing back on the payment. There's lots of large companies that do this routinely, not as far as breaking faith with an existing supplier who maybe has 30-day terms with you, but when you think about big retailers like Costco and Walmart, one of the things that they're famous for is giving their new suppliers particularly six-month terms. So you ship a product to them, you hope it sells, and then if it does, you get paid 6 months later. So that is a typical way for companies to manage cash flow, depending on the industry, depending on your clout as the customer or the supplier, depending on where you are in the transaction. So, TELUS has this opportunity, but I'm sure they treat it with a grain of salt. Longer term suppliers that are making more money from TELUS. TELUS might go and negotiate longer and longer payment terms. Some of the smaller suppliers, they would just pay net 30 days. So that would be interesting to look at something like the handheld contracts with different manufacturers, phone manufacturers, and see what kind of relationships exist. I seem to remember we were talking about that once at one point, and it was a question of sort of what's on consignment, what do you guys own? It's actually fairly complicated and it depends a lot, I believe, on the supplier. But anyway, it's a really interesting area and a possibility for financing for TELUS. Now, trade credit. This came up last night. That was a really good question on what about offering a discount on paying early on your accounts payable. Well, here's an example of offering a cash discount for early payment, and it's the reverse. We're taking the reverse position. We're looking at the cost of not taking a payment that's offered to you to TELUS. So as you can see here from the calculation, it's the percentage discount divided by 100% minus the discount over 365. Final payment date, last discount date. So we plug in a bunch of numbers into a formula essentially. But what we come out with as an answer, 37%. So a 2% discount paid within 10 days as opposed to 30 days regular is equivalent to 37% interest. So this is what I meant yesterday when we were talking about in our synchronous class about trade discounts are actually really expensive. So you should take them when you have payments that you have to make, and offering them is a really expensive form of financing. So you can offer them, but there's probably less expensive ways to do that. Stretching payables. Payables can be stretched beyond their due dates simply by pushing your suppliers. But as I mentioned last night, you may get a ding on your credit rating if you slow pay your customers, if that's not part of your actual agreement with them. So chartered banks in Canada, so here's a listing of the chartered banks, and what they typically do is they offer all sorts of opportunities for business loans, including short-term business loans for small assets. They can finance your working capital and expenses through lines of credit, for example, or loans, but lines of credit usually. And lines of credit are based on a certain percentage of your receivables and inventory, about 75% of receivables, 50% of inventory. if your receivables are insured or of very high quality, it can be up to 90% of the receivables. And so regardless of your facility for your line of credit, it is margined by, you can only use the equivalent of 75% of your receivables plus 50% of your inventory. So you can't always use the full amount of your line of credit, and you have to restate your receivables and inventory every month, and you have to adjust your use of your line of credit if you are overusing your line of credit because your inventory has dropped or your receivables have dropped. So your line of credit's not what's important, it's how much of it that you can margin and use. Collections on receivables, obviously, those can be accelerated and all of that. And then a revolving credit agreement or line of credit. Banks typically call this, a line of credit. The revolving just means there's a note that's passing back and forth, is getting paid off and then taken out and then paid off and then taken out. But it's essentially a line of credit. That you would be used to personally. It just tends to be in increments of 5,000, 25,000. So it's not like our personal line of credits where $20.18 might be used or something like that. In the case of corporations, they generally top you up $25,000 a chunk if you're using your line of credit, and so they throw that much money, $50,000, $25,000, $75,000, something in the $25,000 range, not smaller pennies and things like that to bring you to zero, but big chunks that bring you above zero as far as your use of your checking account. So basically, revolving credit is a secured facility secured by inventory and accounts receivable. It requires a commitment or standby fee on the unborrowed funds. And as I mentioned yesterday, you have one of those at TELUS, your $2.25 billion, and it is your backstop for your commercial paper that you issue. Line of credit is just a non-binding agreement to borrow up to a predetermined limit at any time. So slightly different, but they effectively provide the same short-term financing. And corporations tend to do one or the other, but not both. But you can have distinguished or distinct lines. Typically, they're margined by the same accounts receivable and inventory, so that's why you typically don't have both. But it is possible to have both. You might have a very small line of credit and a larger revolving line of credit. So the prime rate is the rate that the bank charges its largest and most credit-worthy corporate customers. That's based on the bank's prime rate plus that risk premium that we talked about. That is created, the premium is created by looking at what is the credit history of the borrower, what is the security of the borrower, what is the current capital structure, what is the term of the loan, right? All of those questions that you can see there. So that's what banks use to figure out whether or not to give certain interest rates. Because the more risky for the bank, the worse these questions, the worse the answers to these questions are. The higher the interest rate, the higher the risk, the higher the interest rate. But if the answers are good answers that indicate less risk, then the interest rate will be lower. Um, Annual interest rate APR, here's your calculation for it. Just remember that the APR is really the stated interest rate, and that's the most important thing about annual percentage rate. And so you've got a nice little calculation here, but not really required for our course. Interesting though. Cleanup requirements. So generally, short-term loans can revolve and indefinitely. So using some sort of line of credit or revolving credit facility doesn't require a cleanup. Sometimes bank requires that there's a cleanup once a year, that you drop basically your use of your revolving line down to zero for some period of time, just to show that you do have the capacity to repay it should you have to repay it. So that's how that works. But I see that used less and less. That would be an interesting question for our executive in residence, and my guess is that there's no cleanup requirements for TELUS on that, provided that certain covenants are met, because the bank's going to look for your capacity to clean up even if they don't ask you to clean up. And what banks are probably doing more is looking for that capacity to clean up rather than asking you to actually do it. So short-term credit secured by current assets. Um, retail businesses are a good example, right? You need more working capital when you have more inventory, and you have access to more working capital when you have more inventory if your line of credit, flexes with your inventory value. Receivables financing. This is kind of an interesting area for TELUS. You guys are doing some securitization of receivables, and I know we've talked about it even 2 years ago with that group. And I think somebody in this group is actually working on a project for that as well, looking at factoring or securitizing receivables. The idea here is that somebody can extend you credit, give you some cash, or generally give you some cash and take responsibility for collecting the receivables, or not take responsibility for collecting the receivables, but have you pay back as the receivables are collected. So they're really common. It's a pledge. The firm retains the title when you pledge. So in other words, the if the TELUS pledged its receivables, TELUS would ultimately be responsible for the collection, but in factoring, you're really selling the accounts receivable, so you are no longer responsible for collecting the accounts receivable, nor do you have access to them. You don't own those accounts receivable anymore either. So pledging, you still have quite a bit of the risk. With factoring, you have obviously passed on that risk to somebody else and paid some sort of a price for that, but had cash in your pocket today, and that is the trade. So AR is used as the collateral for essentially a loan, and then the AR can still belong to the borrower, as I mentioned. The TELUS would still collect the accounts, just as an example. And yeah, so that's how that works with pledging. And then factoring, it's basically selling the accounts receivable to a lender at a discount, and then the lender deals with all of the collections. So there's a lot of different things that can be done as far as factoring accounts receivable. Factors can do credit checks, credit authorizations, and help you with that whole credit worthiness aspect of your firm and how it works, how TELUS works. They can do customer billing for you, etc. So accounts receivable factoring firms generally provide a lot of adjacent services and can help you outsource a lot of that credit and collections, even to some extent your policy on receivables can be at least applied to this outsourced firm. Inventory. So types of inventory: a blanket inventory lien, a trust receipt, and warehousing. So those are all slightly different in terms of, so we'll talk about each one. So in a blanket lien, the lender has a claim against all the inventories of a borrower. So it just has a blanket right to the inventory should something be broken in the covenants of the agreement with the borrower. So the borrower remains in physical control of the inventory. So TELUS would retain physical inventory of the borrower, their own physical inventory in this case. It would just be that the bank, probably one of the big banks basically, would have a lien against all the inventories and could seize them if a covenant was broken and dispose of them then to make good on the borrowing. A trust receipt is basically when you have inventory identified by serial number that can't be sold without the lender's permission. And automobile dealer is the perfect example, where basically once you sell something, you have to get the authorization of the bank that you're working with, and you can't sell it without their authorization. It's in your physical control, but you don't have permission to sell it. So you don't have authority really over the sale of that asset unless you're allowed to sell it by the borrower or the lender, sorry. And then warehousing. This is where your inventory is actually taken, so to speak, placed in a warehouse, and you have access, but there is some sort of trustee or third party that wants to make sure that you have access if you're allowed to have access, but you don't take anything that you're not allowed to take. So those can all be used, but we typically don't see them used regularly, except for in really specific ventures that have these types of inventory issues where maybe the company is not that big, doesn't have a lot of credit, and so they have to work very closely with their bank, and their bank has to have certain security features in place of one of these three options. So They're all available to companies. Money market instruments are those really short-term instruments we talked a lot about yesterday. Commercial paper, bankers' acceptances, and securitization of receivables, of which TELUS uses commercial paper and securitization of receivables and doesn't use bankers' acceptances. So just really briefly, again, commercial paper is notes. We're generally talking less than a year, in fact, less than 270 days. They are unsecured. They don't usually have an asset behind them. And because TELUS is TELUS, that's a good example of a company that can issue commercial paper. Smaller companies can't issue commercial paper because people who might put the money in and get the financial instrument in exchange wouldn't necessarily be comfortable with smaller companies that would want to receive these notes. Like they wouldn't be interested in them because they don't know the company. They're generally considered very safe because of the type of companies that issue commercial paper, well-known, reputable, mature companies, and they're sold at a discount just like a bond. So whoever is buying it pays something less than the face value, and when the commercial paper matures, then the company repays the full amount or face value of the agreement, the note. There's no flexibility in repayment terms. These are pretty, because they're fairly short duration securities. There's no flexibility to renegotiate. You don't even have time to renegotiate. They just are what they are. This isn't important, so you can ignore that. Yeah, because you already know how discounted calculations go, and these formulas aren't as helpful as using your Excel. So that would be a discount present value, just like any other present value calculation. And we're not going to do yield calculations unless they're very simple ones, which many are not. Okay, bankers' acceptances. This is a non-TELUS option for smaller companies where if I'm a small company, I pay my banker a stamping fee, and that banker then guarantees the loan, takes the risk of the loan, and the yield on it, or the interest rate that will be paid on that, will be equivalent to that of the bank's risk. So it'll be really low. So, I'm a relatively young company perhaps, and I'm relatively risky. If I pay my bank to guarantee it, then I pay a way lower interest rate because I'm getting the bank's interest rate, what the bank would pay to people. So very low risk. But I have to pay the stamping fee to get there. And my bank is also really checking my credit worthiness because they're at risk. If I default, they still have to pay the loan to the people who purchased the banker's acceptances. So they're at risk, and they're going to be right on top of my company to make sure that we're sticking to our covenants. And then finally, securitization of receivables. Sale of receivables can be done by public offerings arranged by securities dealers, and essentially you're getting cash today, and you are giving somebody else your accounts receivable in exchange. So that's typically how securitization